This is day 2 of the seminar, and hope you guys went home last night and dreamt of gap plays and things like that. Yeah. We actually went home trying to do a gap play, but if you can't get an internet connection, it makes it a little difficult. We were fiddling around with the internet connection in our hotel about midnight, and then about that time they'd said that they'll send somebody up in about half an hour, and da-da-da-da. It's just like, no, it's not going to happen. Yesterday we spent most of the day just kind of, starting off with just kind of the foundation. We put together the hardware and software, some basic mechanics of the markets that we trade, went over the gap play. Today we're going to spend a lot of time covering setups. But before we start setups, what I want to cover is what I think is kind of near and dear to my heart, and one of the most important parts of trading is trader psychology. And I got a really good sense yesterday when we went around the room, everyone kind of did an intro that a large number of you, this is something that you've thought about and kind of wrestled with and things like that. So this is something I normally do at the end, but I think this is a pretty good place to do it. So what we're going to do today is start with trader psychology. And this is all stuff that I've pretty much learned on my own, as well as doing a lot of reading and working with people like Mark Douglas, and just different things like that. I mean, it was definitely my trader's journey was a lot of kind of the trading psychology and stuff like that. And so I just want to kind of share what I've learned during that time, because I think that's just been a big difference in terms of becoming a consistent and profitable trader versus, hey, making a lot of money, losing a lot of money, and just kind of those ups and downs and things like that. So before I start, any questions from any of yesterday's stuff? One question someone had come up and asked me just before we started was, hey, on these gap plays, a lot of times, they open at 9:30 a.m. Eastern, and a lot of times at 9 o'clock, the gap's already starting to fill and things like that. Is it okay to get into the gap play before then? It's certainly okay to do it. The data that I've collected and the data that we've collected is based on the 9:30 open. So we don't have any data to back up what happens if you get in earlier, like at 9 or something like that. But if you, as part of your trading, as you notice things like that, certainly that's, you start recording the data, see how it works for you, and then you're able to do that. And when I go through the trading plan, I'll show you kind of some different ways to track that and things like that. But that was a good question.
John, when is a gap a gap? Is 1 point, do you consider that a gap, or 2 points?
Yeah, I mean, if you've got, the question is when is a gap, and I guess the real question is when is a gap a playable gap in terms of, yeah. For me, like on the S&Ps, if it's over, it's a little tricky when it's like let's talk about the Dow. If it's 10 points in the Dow, it's a gap. It's just, 10 points is a hiccup. So, I mean, you go in there with your 1.5 to 1 risk-reward ratio, and you could get stopped out on a hiccup. So I found that they usually fill very quickly, and it is something to, you could sit there and do. I personally will only, for the gap stats that I do, I'm only doing it when they're over 15 points at least.
That's on the Dow.
On the Dow. So it'd be 1.5 points on the S&Ps.
On the Russell?
I don't play the gaps in the Russell. I just do it in the Dow and the S&P. But the equivalent on the Russell, 10 points on the Dow, you're talking like about half a point on the Russell, give or take. I mean, it's it's not a perfect match.
You see them, is it an automatic play for you? I mean, is it 1.5, 2, 3 points? Is that basically, or do you wait for the TTM or other indicators? Or?
No, that's a good question. I mean, is it if the gap comes up, am I just taking it right away, or am I waiting for TTM? For me, it's an automatic trade. It is a trade that you can, try these other things with and things like that. But I mean, my experience, I did the gap for years and years while I was working and not watching the parameters. And by far, that was kind of what made me make the jump from being able to, working in corporate life to being a full-time trader. And when I became a full-time trader and then started trying to tweak it, it became less consistent. So, no-brainer for me was to go back to do it like that, and that's how I do it today. Now, that doesn't mean like once I'm in the gap play, I'm still doing other plays, pivots and squeezes and stuff like that. But the gap play I just do, it's kind of auto-traded, autopilot, stuff like that, and it's done. Okay?
The data you showed us yesterday on the gap fills and which ones are most likely to close, was that with or without stops? That was without, right? That was just pure...
That was pure gap data. And what we found on that is that if you had, part of the data was, okay, what happened if you use like a 1 point stop every time? Then you got stopped out like 98% of the time. Or if you use a half a point stop on the S&Ps, you got stopped out every time. So that's what we played around with. It's like, okay, if 1.5 to 1 risk-reward ratio, then it became more of an 80% probability that it's going to get filled without getting stopped. Okay? Easy enough? More questions to get me warmed up here? Okay, good. So what I want to do is go through trader psychology. As we go through this, feel free to ask questions. This is kind of a... I spent a lot of time, the book that's going to be coming out, I also spent a lot of time, working on a couple of chapters on that, so I'll kind of integrate that into it as well, which is not in the slides. But if you have questions, just go ahead. It's kind of a start to finish with the trader psychology, so some of the things that, you may have questions on may get answered on the next slide and things like that, but this is pretty much what we're doing. So, as you guys have probably guessed at this point, anything having to do with emotion is the enemy of successful trading, okay? I'm going to switch over here so I can actually read this. One of the things I think a lot of people don't realize with the markets is that they're actually set up to naturally take advantage of human emotions, okay? It's like, why do the markets move the way they do? It's because you've got human beings making decisions. And whether the humans are making the decisions on their own or the humans program things that are going to do the auto trading, you've got human beings making decisions, okay? And as you guys are probably well aware, if you've got a human being making a decision, there's sometimes things like irrationality and fear and greed and all those wonderful things come into play. Perfect example, London bombings. I mean, I've talked to people in this room where, the market's coming down. All of a sudden, all rationality gets thrown out the window. It's a bombing. That means the market's going to crash. Got a short. And it's all emotion-based reactions. And what happens is that until you realize that the markets are set up like this, you're going to get taken advantage of. Okay, there's a rule of thumb that I use when trading with the markets. The markets don't move because they want to; they move because they have to. Okay, when are the times that the markets are going to move the most? It's when the most people are trapped on the wrong side of the market. This is whether you're looking at a 1-minute chart or a monthly chart. What do I mean by that? Extreme example on the daily and weekly charts. How many people are stuck long at March 2000? Okay, everybody's long. True story. My brother, he had saved up, I think it was like $50,000 or $60,000, and he was working in Los Angeles, and he was it took him a while to save up this money, and he'd been watching the stock market go up, 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 and I swear, like on March 5th, 2000, he buys 1,000 shares on margin of F5, FFIV at 105. That day, he sits down, eats his cereal, he watches it go to 113, which is like the dead highs, and as soon as he sees it go to 113, he goes off to work, and he's like, oh, this is great. I just made, $5,000, $6,000. That was the dead highs. It closed lower than that, and he held on to it. He finally did sell it. He sold it at 3. And now it's reversing, gone back to 50. But this is a good example of markets moving not because they want to, but because they have to. The reason F5 was moving down now, it has nothing to do with valuations, nothing to do with fundamentals. What it has to do with a lot of people who are stuck long, and now the market are going to keep coming down until the long-term investors feel enough pain that they finally capitulate and get out of the stock. Okay. Once the long-term investors feel the pain and that causes them enough pain to take action, the market's going to bottom out. All right, that was an extreme example on a daily and weekly chart. It's the same thing on a 1 or 2 minute time frame. What I have found in the S&Ps and the Dow, intraday traders can take about a 50 to 60 point move against them before they capitulate and get the hell out of there. So if you see a move on the Dow that's like 50 points, you got to remember, if you're long and the market goes up 50 points, it's a good place to take profits and or fade, because the people who got in at the dead wrong part of the move, about that point they can't take any more pain, and they're not going to get out rationally. They're going to be screaming at their computer. They're going to be banging their keyboard. They're going to be covering at the market, and that's what causes the market to go higher. Okay? You guys have all been in the situation. I've been in the situation. And if you think of a move with one trader times 10,000 all trying to do the same thing at once, that's why the markets move. So it's important to understand why the markets move, so then you can kind of take advantage of that in your own brain and stuff like that too. So the other thing that's very nice about trading markets is that all the things that you have used in your own life to achieve your goals, whether it's starting up a successful business or pursuing the woman or man of your dreams, or whatever it is, all these tactics that acquire determination, positive thinking, all the traits that make a person a success in life will get you killed if you try to do that with trading. Okay? What do I mean by that specifically? In life, positive thinking is a great thing to do, but if you apply the same principles of those positive thinking to visualizing the outcome of your trades, you're dead. It's okay to be positive and think, I'm going to make it as a trader, but if you're in a trade and you start going, okay, if you wake up in the morning and you're doing your visualization, it's like, I'm going to make $1,000 today. What's going to happen is you're going to get in a trade and it's going against you, and you're going to be like, well, it's going to come back up because I saw a clear picture in my head of myself making $1,000. I listened to the Tony Robbins tapes. He said if I did this, da-da-da-da. And it happens a lot. I mean, I've talked to people who have done that, and they just get so frustrated because they saw the money, they felt it, and somebody else took it. So I think this is something just to be aware of. In trading, when you get into a trade, it's better to be more pessimistic. It's better to think that you're getting into a losing trade. That way, you start focusing on how much you're willing to lose, and then the upside will take care of itself. And the other thing too, the tricky thing with traders, and this is so true, in trying to explain things to your spouse or people who are close to you, and you're making a living as a trader, they're going to come up and ask you, how'd you do today? Well, I lost $500. It's like, you should do something else. And it's like, no, $500, that's part of my plan. It's a good thing. I stuck to my plan. No one will ever understand that except other traders, okay? Hubert and I will talk to each other in trading. It's like, well, what'd you do today? Oh, I lost $10,000, or I made $20,000. And it's like, okay, that's great, but did you follow your plan? Yes, yes, yes here, no here, and it's just traders understand that. What the problem is when people first get into trading is that, how does society measure success? Okay, if you're a business person, they measure success by the amount of money that you're making. If you're a clothing designer, you're whatever. If you get on the cover of Vogue magazine, you're a success, whatever. As a trader, obviously being a successful trader means you're making money. So what happens is that gets wired in your brain. The market comes down one day, you have a mental stop. It comes down through I remember these things. It comes through your mental stop, you let it go, you sit back, it comes back up to break even, and you get out. Good. So what has happened now, the market has just taught you that anytime you use a mental stop, you're going to be able to get out at break even. So that may happen 6 or 7 times, but it only takes one time to kill you. And that's the kind of habits that get set up in place like that. So it's just important to realize that how these kind of external factors come in and set up your decisions when you're trading like that.
Can you repeat that mental stop? I just didn't get it.
Okay. Say you're in a trade. What do you trade? All right. You're long 10 contracts of the Dow at 10,000. You put in a mental stop at 99.80. Like, okay, if it comes down to 99.80, you're just going to get out. If it comes down to 99.80, 99.79, you're getting ready to get out, and you're like, I think maybe it's going to come back up. It comes back up to 10,000, and you get out at break even. All right. So what are you going to do the next time it comes down to your mental stop? If you're thinking about it, that's a problem.
I'm going to let it go.
Yeah.
Yeah.
Exactly. Yeah. So what happens here is that on something like that, where if it works for you one time, you're dead, because all it takes is one time not to work. All right, and this is and it'll happen, and that's how the markets go out and take out people who are undisciplined. It doesn't matter because you can get by for months at a time. It's just the one day that'll take you out.
So what do you do in this case?
Take your stop.
Just
Take a guess.
sell, check your indicators, reposition.
Always, you put your stops.
Yeah.
Always.
So John, you saying you use hard stops anytime you enter?
I use hard stops.
You absolutely place your stop hard.
Yeah. Well, I'm going to trade. I don't want to watch it anymore. So if I don't want to watch it anymore and I'm leaving, I have to have a hard stop and a hard target.
Okay, and when you're out now, and you trail your stop to be -3, you place that hard as well.
Yep. Makes it a lot less stressful. I mean, that's part of it too. It's like instead of now, because what will happen is when you're in a trade and you start trying to think about stuff like that, is now instead of trying to focus, when I'm focusing on the markets, I want to be objective. Which way is the market going to go here? If I'm in a trade and I'm trying to manage it real time, I'm not sitting back looking at the markets objectively. I'm now totally zoned in on my trade. The emotions are going back and forth. Is this going to be a winner? Is this going to be a loser? And it's a complete waste of time and a waste of energy. And again, a bad habit like that only has to work once, and you'll keep using it until your account's at 0. It's just if there's anything that
It's called feeding the beast.
Feeding the beast. The account goes to zero, you refund it, try to make your money back, you do the same habits, it's going to go to zero again. If there's anything I can tell you during these 4 days together, it's just if you break that habit, if you get a stop, be proud to take a stop. It's going to put you ahead of 90% of the other traders out there. Jerry?
On page 92, you've got a gap example where it's like a 300-point, it goes away from you 300 points before it comes back and fills.
Okay.
All right. Where's your stop?
1.5 to 1 risk-reward ratio.
1 to 1.
Or whichever one that is. I mean,
in other words, obviously that's a long, that's 66 to 1.
Yeah, he would be stopped out on that one.
I don't have it in front of me. I mean, I can't see it.
I'm just saying, in other words,
Oh my God.
you've got to go ahead and obviously you're not going to win on every trade. So the idea is, what's a reasonable stop when you're looking to fill a gap or something like that?
Again, it's like kind of what we talked about yesterday. It's like you when you're using your stops, it's more of a monetary thing. If you don't want to lose more than $200 on a trade, and you normally trade 5 contracts, and now you're going to have a 100-point stop in a trade, you bring that down to 1 contract, and now if you get stopped out, you lose the same amount of money each day. The whole idea in a trading plan is you figure out how much money you're willing to risk a day. For me, it's 2% of equity. I'm not going to lose more than 2% of equity in any one day. So that means if I'm willing to get stopped out 3 times, if I'm going to use 20-point stops in the Dow, then I just do the math. That means I can do 40 lots, get stopped out 3 times in a row at 20 points, less than 2% equity.
Trying to say you don't want to worry about the trade anymore, so you place your trade, you place your stop. But what about your target? Because a lot of markets that you play, you're going
that's
to
a good question.
Extreme moves to the upside and then retracement.
I'll tell you how I do currencies a little differently. And the question is okay, I place a hard stop, but what about a target? What I do, like in the currencies, is because they move so well, is I'll get into a trade, I place my stop, and then I'll place a target on half. The other half is an open target, and then I just trail it. And I'll just keep trailing it until I'm stopped out. Example, and these are setups that we'll talk about. One of my favorite plays in any market is just doing price breaks, reversals, high of the low day and low of the high day, which is a setup we'll talk about. Once you get in the trade, there's no target. You just trail the stop 2 bars back on a daily chart. And so when you do get a nice trend, you're in the trend the whole time. And I don't have a target. I just stay in until it reverses again.
Is your software trailing it, or are you changing it every time?
I trail it. End of the day, stop. End of the day, up. New. We'll talk about it. But I manually change the stop at the end of every trading day.
I saw a trade you put on 2 weeks ago. Basically, it was a Friday, I believe. You put it on. It was on the euro currency, and you placed a 70-point stop on it. You recall that?
Yep. ECU short.
Yeah.
120, 198 or something like that.
Exactly. And 70 points. That's a heck of a stop.
It is if you're using 1,000 contracts. I mean, if you've got example. It's a good question. 70-point stop. If a big stop freaks you out, that means that your contract size for that position is too big. Okay. What's going to happen is, let's say currency. You normally trade, 10 lots, whatever it is. In any situation, if you expand your stops, you're going to have a better chance of the trade working out if you feel that your research in the direction of the market is correct. So if 70 pips on 10 lots, which is $7,000, is too much for your account, if that's going to represent like a 10% loss to your account, then you reduce that and say, okay, I'm going to trade two lots on this trade. So now if you get stopped out on 70, you're not stressed out, and it's not going to be a big deal if it hits your stop.
Well, you never discuss your target on that trade, but I assume that you had some risk-reward ratio in mind that put you somewhere around a 100-point target.
Yeah, I think on that one we had what was it? It was in just under 122, and we're looking like at 115 or 116. It didn't get down there. We just trailed the stop and got out, or we wanted to get out before the employment. Is that the one before the employment numbers came out? Okay. But again, it really comes down to position sizing. I mean, for me, there's a saying for trading, like you sell down to the sleeping point. If you're laying in bed at night and you're worried about a position, it's too big. You get to the point where if you're stopped out, it shouldn't be a big deal. And I think that's the biggest difference between, I've noticed in newer traders or people who've been doing it for a while, is they're never willing to, risk it all in one trade. If I get stopped out on 100 pips on this trade, that should affect my account by 2%.
You mentioned 2% of equity in any given day. How much allowance do you give yourself for a single trade?
That's a good question. We're getting a little off track here because this is stuff I'll talk about during the business plan, but I want to answer that question. How much do I give on any one trade? Well, if I want to lose 2% equity on any one day, if I'm just setting up one trade that day, I can give it a 2% stop.
Sure.
If I'm like day trading, I know I'm going to be doing multiple positions. Generally for day trading, I want to be able to get stopped out 3 times in a row and still be okay. So that means on each trade, I'm risking like whatever that comes out to, like a third, exactly, like 0.78 or whatever that is. So it's just doing the math that way.
And then after let's say your first 2 trades are break even, you can risk your whole 2% on the last trade if you want.
If you want to, yeah. But the idea is that, you want to be able to live to fight another day and not blow out your account in one trading day like that. Okay? I mean, it's not as exciting, but then at least you can do this for a living. Okay. Yeah, and I think the main thing is with trading is that the rest of the world. If you tell the rest of the world that you sat there and took 3 losses that day, the rest of the world is going to tell you you're not a good trader.
The best way to have a social life is go to a party and tell people you're a trader. You're better off saying, I have AIDS and a tumor in my brain. And they'll stay with you longer if you say that and then say, what do you do for a living? I trade. Oh, you're a day trader? Ching gone.
They're like, that's not.
In the 90s, you were a folk hero.
Yeah. People get freaked out for some reason. You swear to God, I don't have AIDS, I swear.
Yeah, it's true, right?
It is, man.
Yeah, it's amazing. So, something too that, this is something I've noticed, and this is just in working with traders, plus in kind of, following my own path on this. This is the cycle I've found that most traders go through, okay? And what happens is everybody starts with great intentions. Nobody goes into the market to lose money. And usually what happens, and this is like, it's like Lady Luck usually visits, your first time to the blackjack table, your first time in the markets. Usually the first couple of trades work pretty good. This is great. You get excited. And then what happens is that a series of trades sets up that become very painful. And, now it kind of shakes a trader up. So the best mental outlook a trader can actually have is kind of like the time when you placed your first trade. You don't know you're not really sure what's going to happen. You want to give it a shot. You have no preconceived notions of what could happen, and that's actually the perfect mental outlook to have on each trade. But what happens now is then their account's down 50%. So now it's kind of like they operate on a new thing instead of having an open mind coming into a trade. Now it's fear-based trading. Okay, I just don't want to lose any more money. All right, and you would think that would make sense, right? Because I'm going to focus on my stops. I just don't want to lose any more money. But then what happens is that's all you think about. You don't want to lose any more money. It's kind of like the thing that you focus on is what comes to pass. If you're playing golf and you're like, okay, I don't want to hit the sand trap. I don't want to hit the sand trap. Sand trap. So that's not a good way to operate either. It's like, and what happens, the mental thing that happens is if you focus on not losing, anytime you get a little profit, you take it. So if you find that you're in a trade and you just can't, if you've got a target, but you just like, as soon as you get a profit, you start getting, you don't want to lose it and you just take it, that's the base you're operating from right now. Okay? Now, the phase 3 in trading is what I call the search for the Holy Grail. Okay? You've done phase 1, you just kind of start out. Phase 2, you're a fear-based trader. And phase 3 is that, it's like, what? I've learned now to keep as a fear-based trader, you're really good at keeping your stops. Now you realize that, boy, you just need better indicators. So you go out and, you go on the search for the Holy Grail. You try to find everything out there that's working. This is when I know when somebody is on the search for the Holy Grail and they'll get a phone call and it's like, have you tried the MACD with the 12-26-10 setting instead of the 12-26-9? And I found when I back tested it for 87 years on every day that it done or not. And it's just like, okay.
That's not funny, John.
And so if you find that if you're in a situation right now, and and this is true. I mean, I've got friends of mine or family members that they've been doing this for 20 years. It's just looking for the next best thing, the next best thing, the next best thing, and it's just not out there. And again, remember yesterday when I was talking about those traders, the lady who's trading 100 big lots of the S&Ps, trading off a cathode ray tube and stuff like that. I mean, I'd ask. It was funny. I was like, well, don't you use like a MACD or anything like that? What's that? Yeah, it's just like but. And it's like, and I think actually I was showing her one of my setups, and after she gave me about 5 minutes, and then she just started laughing. She's like, "Oh, that's very cute." 1533, very good. That's nice. So what happens is that, and you got to remember, all indicators are lagging, right? So pretty much all indicators are the same anyway. But what happens is if you start going and you're searching for the next best thing, yada yada yada, it doesn't change any of your habits because and this is the same like with back testing and things like that too. The problem with stuff like that is that no 2 days in the market are ever the same. Okay, I know a lot of technical traders will tell you that, well, if you look back at the history, that's going to give you a good idea of the future. Well, that's great. I mean, but again, it goes back to like the 9/11s of the world, the London bombings. I mean, every day in the market's different. Not only do you have an event out there that could come in and kind of change everything, but guess what? Every person who's participating in the market that day is different than the day before. Okay, how do I mean that? Well, yesterday maybe 2 traders got blown out and they're taken out of the trading pool. Today, one guy that was up $10,000 is down $10,000, so he's acting differently today. One day, one guy's initiating positions, whereas the day before he had positions and he was closing them out. So you've got millions and millions of data points coming into the market, and every day they're totally different. Okay? So what this comes down to is that there is no holy grail system that's going to be right, every time. It comes down to you as a trader having the discipline to say, all right, these are the setups that I like. I've shown that they have a little bit of consistency. I'm willing to risk 2% on my equity. Let's go. That in and of itself gives you a leg up on 90% of the other traders. Because remember, the other traders out there and how you're making money on that is that you got the other traders out there holding through their mental stop for a 6-point loss in the S&Ps while you took the 5-minute squeeze to the downside and you're trailing your stop or whatever it is. It's amazing how many traders out there are just operating without kind of a game plan. It's the green bar buy, red bar sell mentality. So there is a good holy grail system that I found, and this is the best one that I've seen. All of our buddies over there at CNBC.
Don't mind me, I'm just long under contract. So no connection.
Where's your picture?
Where's what?
Your picture.
Don't listen to me. The reason I put that up there is what happens is a lot of people, when they first start trading, and this is what I did too, okay? You're in the corporate world. I feel like that I don't have much information to work with. Boy, wouldn't it be great to be right on the cutting edge of everything. So what do? You quit your job, you get your computer and put CNBC, right there. And, ding, 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 ding. And what happens here is that, first of all, you got to remember that CNBC, the main reason that they exist is to generate revenue for their parent company, General Electric, in the form of advertising revenues, okay? They're not there to give you tips and things like that. What happens is when you listen to something like this is that it takes your focus off the setups that you're looking for. All of a sudden it's like, oh, this just in, there's a potential oil explosion in Kashmir. Okay, well that's great. Even if it was news that you could use, everybody who's on the trading floor heard it 15 minutes ago. Okay, you're not going to make money off that news. If anything, if you watch CNBC, you fade the news on there. But I don't think that that's a good setup. I think you're much better off turning off the news and just focusing on the charts. The charts are going to tell you everything that you need to know. If you find that you overtrade, one of the things that you can do is if you're watching a financial news channel is just turn it off. And that'll help your focus a lot more dramatically on the markets. The other thing, in terms of fear and greed, the things that I found, instead of fear, greed, of course, is very bad, and even worse is euphoria. For greed, what happens is that, maybe you've got a good thing going, you've got a $25,000 account, maybe you're making a couple $100 a day, let's call it 300, and you sit down with your spouse one night and she's asking, hey, I understand you're trading, how's it going? Oh, I'm making $300 a day. That's wonderful. Well, I'd like a new BMW, and I like red. So it's like, okay. So as a trader, you sit there and make the calculations, and it's like, okay, if I'm going to get the BMW, then I want to save up money for a down payment, and then, okay, I need to make $600 a day. As soon as you do that, as soon as you decide that, everything in your brain is rewired to make you an unproductive amateur trader. Because what's going to happen is the next day, you're going to get into the markets, you're going to get what used to be a reasonable profit the day before, but today it's not because you need to make more money. So you don't take the profit, and it turns into a loser. Or if you've got a losing trade, you don't take the loss because you can't afford it because you need to make $600 a day. Or you start over trading and things like that. So there's always a balance of about like how much money a trader can focus on and things like that. And again, it goes back to if you're focusing on the money, all of the habits that ruin a trader automatically kick into play. If you focus on the setups, the money takes care of itself. So what happens in a situation like that?
The problem you discussed started when you sat down with your wife and told her what you're doing. I'm very serious about that. You don't do that.
Yeah.
A trader does not do that.
That's actually, it was funny, one guy I was talking to about that, and if you guys have read Reminiscence of a Stock Operator, there's the fur coat analogy, and it's kind of the same thing. And I was talking with one guy about this, and because he was getting frustrated, because he finally identified it, and he's like, I know the perfect solution. I'm like, what's that? He's like, I'm just going to divorce my wife. It's like, it's not the,
She gets half.
Yeah, exactly.
John Carter told me.
Yeah, thanks.
If that worked, it'd be worth a try.
Right. If that worked, it'd be worth a try.
On a serious note, you should be able to hold up your quarterly or annual P&L to your spouse and not have to worry about it on a longer term.
Best way to do it is with another trader. Like hook up with somebody here, because he's going to know the ass kicking that you just took today, and your wife's going to be like, "Oh, it's no big deal," or "Oh, that's terrible," or "What did you?" But if you've got somebody that you can be accountable to every day, like you can call and say, "All right, here's what I did. I lost money, but I stuck to my plan." Then the guy will be like, "All right, cool, you're fine." I mean, even if you just do it 5 or 10 minutes after the close, and then you'll be like, "All right, how'd you do?" Did good. 3 of my 5 setups worked today. Made some pretty good cash. It's easier to talk with somebody that's actually in the trenches doing the same thing you are than opposed to, my eyes glaze over when my wife talks about curtains and painting and clothes.
I trust your judgment, honey, I swear.
Yeah,
Actually, here's the biggest problem I had trading, too, when I started off. It's euphoria. It wasn't the greed of, trying to make more money. Even if I was focusing on that, when I was really got to the point where I was focusing on setups, and I was like, okay, I'm pretty comfortable with this, comfortable with taking losses, comfortable with managing the upside. What happened is there'd still be some days where I just have, phenomenal days, and just like, wow, everything, all the stars aligned. You have this great trading day, and what happened is always like the next day I'd have like the worst drawdown of the month. Okay, and this happened many times, and finally just figured out it's like the euphoria. What happens is you just get it's like you feel like you could do anything. Okay, everything you touch turns to gold. Why trade 20 lots when you can trade 100? That kind of a thing. Yeah, actually, okay, 2 stories of guys that I've worked with in this regard. The both of them are bad, but I'll start with the less bad one first. One guy, he called me up one day, and he was managing a hedge fund. And so at first I thought he was a hedge fund manager, and we started talking. I'm like, oh, this guy knows nothing. I'm like, what are you doing? He's like, oh, well, it's my family trust. And I figured out that he was the only one who knew how to use a computer. So because he could connect to the online broker, they decided to turn it over to him. So he was following an internet service that recommended to short Yahoo at like $15, okay? And when he called me the first time, Yahoo was at 18, and he still had it. And we weren't really talking too much detail. I was just like, I looked at the chart, the March 2003 bottom. I said, I don't think I think Yahoo is a very overflated, internet company, but the chart says it's reversed. I wouldn't be short the stock. I mean, personally, I would just cover and he's like, well, what I'd like to do, he's like, do you think it'll retrace at least $1? I said, I have no idea. I'm telling you that I think I would not be short the stock. He's like, okay. All right. So he calls me back like 2 weeks later. And of course, this time I got Yahoo on my watch list because I know someone out there is short. And
It needs to cover.
yeah, it's cheating. And he calls up and he's like, well, and of course as soon as he calls, and Yahoo quote, and it's at 2021. He's like, well, I was thinking that when we talked, you said that it might pull back. I said, okay. He's like, well, I doubled up on my short. I'm like, okay. And I said, well, I want to be clear here. What I said was that this was a bullish chart, right? And he's like, well, yeah, you did say that. I was like, okay. So now it's at $22. He's like, well, do you think it's going to pull back to 20? I said, look, you're playing, and I started like, you're playing the wrong game here, okay? And how many shares are you short? And he wouldn't tell me. And finally he said it was 500,000 shares. And so now he's like, well, look, I can't take the loss. My family would kill me. I'm like, the loss is there right now. He's like, well, but yeah, they don't see it because right now it's just an open position. They don't worry about that. So I'm like, and I was just like, well, I said, honestly, you need to take your lumps and move on. He's like, well, look, I've been doing this chart analysis, Fibonacci retracement. I think it's going to go back 38%. If I short another like 300,000 shares, then I'm only going to be down, whatever. I'm just like, and I just said, absolutely, I would not do that.
I would have said, hell yeah, that's a good idea.
Yeah. He's like, okay. So
you just call me when you cover that bad boy, all right?
So then now I've got Yahoo blown up on one full screen. It's like going long Yahoo. But it turns out, it's just what happened is he had no stop in place. I did talk to him like a month later. This Yahoo shot up to 30. When it got up to 28, he couldn't take the pain anymore. He just covered at the market. Lost 60% of the $10 million fund on one trade. Okay, it was like $4.2 million when it was over. All right, this stuff happens every day, whether it's on a 1-minute chart with one guy with 2 lots, or it's some guy that just inherited his family trust fund. It doesn't matter what it is. That's what makes stuff move. One of the things that I like to do is anytime I'm in it. Well, let's do the next story. The next story is a guy. He was in Texas, and he was part of the Lucky...
Oh, my God. This is the best story.
We call him... He's an LSC. He's part of the Lucky Sperm Club.
Is this the anesthesiologist?
No. This guy had an uncle who died and left him $102 million. Okay, Lucky Sperm Club. And what happened is he got his money, and it wasn't like he was like living in a dirt cabin or anything like that. He was like an attorney, and he's making a couple $100,000 a year. Now he just got a $100 million windfall. So now I'm trying to remember exactly when this was. I think it was September 2002. Tech stocks are coming back. They started bouncing back. He put all $100 million in tech stocks on margin. All right. September 2002 to about March 2003, we had a pretty hardcore sell-off, okay? And he got to the point where he could not take the pain anymore, and he was realizing, he's like, gosh, if I'd have been short this whole time, I'd be up like at $180 million. Calls up his broker, sells all his longs, maxes out short. This is March 5th, 2003. All right, we're just going to bring up a chart. Yeah, that's 7903. Okay, that's 03. All right, so let's recap, shall we? Here's where he gets in. If you guys can see that, where the mouse is. It gets in right there. Actually, he gets in like right here, because the first week or so he was ecstatic. Then he had the big sell-off, almost freaked, and then we started recovering. He's like, oh, thank God, thank God. He actually gets back to break even. And now he's like, okay, this is great, things are going to work out. Then we roll over here, and we come down, and we don't quite get to the same lows, but right here he's just tired of it. He's seen the market going down every day for 2 months almost. And literally about right here is when he does the reversal and goes short. He's got 2 days where he makes money, and then we have like monster rally. Up here at the dead highs, his broker calls him and says, I'm taking you out of your stuff. He's like, why? Because if this goes up much higher, you're not going to have enough money to meet the margin call. He's like, I don't understand. So he liquidated all the stocks. He got a statement back. He had $918,000 left in his account. And this was in 5 months. Okay.
Tell the Vicar Niederhoff story.
That's Darwin's law there.
That's another one. So the thing to remember is that when you're in a trade, just remember and one of the things I always do is just think about who's getting squeezed here, because this happens all the time. Now, those were two people that didn't know much about the markets, right? Another guy who actually, and I read his book, I think it was the Victor Niederhofer. I thought his book was great on trading. He had a method where in 1997, he had a fund that had like $300 million. What they were just writing naked puts on the S&Ps. Hey, naked puts, selling premium, this is great. What happened was is then the market started coming down to the point where it was getting a little close, too close for comfort on the margin calls. The brokers there at the desk started calling around the floor going, hey, if for example, if I had a client who had this position and the S&Ps went down 10 more points, what would happen? And they're like, you'd have to liquidate the position. Well, the pit traders got a hold of that, and they're like, no bid. They just stepped away, and the S&Ps on that, I don't, okay, let's look. It's October 97, I don't remember the exact day. Oh, right here. Yeah. So this is a weekly chart, so it's not as much of an impact, but you can see that the S&Ps high of the week was 950, low of the week was 850, 1,000-point range in the Dow. So on this particular day, what happened is the pit traders got wind of this, that this guy was in trouble. They stepped away from the bid. Literally, they just wouldn't buy it. So the S&Ps crashed. When they were down 30 points, they had to start liquidating the fund, which drove it down another 20 points. And at that point, they're like, it's all liquidated? Okay, we'll go ahead and buy it. And the pit traders, made like 50 points on the big S&P contracts that day. Okay, this was an experienced trader. It's not just, it doesn't just happen to mom and pops. Okay, the markets don't move because they want to; they move because they have to. When you see stuff like that, it's not because all of a sudden the stock market's overvalued. It's because someone's getting hosed.
I have a question about mechanics of that move. If people back away the pits, the futures traders aren't buying. But there's an underlying cash index, right? And the institutions are out there doing their regular thing. Unless the underlying cash moves, the futures
Good question.
aren't going to...
What happens, though, is the futures drive cash because of all the index funds and all that stuff. When the futures go higher, then they're forced to reallocate stocks and things like that based on all the S&P 500 and things like that. Futures first, then the stocks go.
John, what triggered you to take money out of your account when you're on the plus side?
Oh, okay.
Is it a offer? Is it
His wife.
Yeah.
Yeah. This is a good question, and let's get back to the. I'm going to close this down. The question is what triggers me to actually take money out of the account? It's something I'll talk about in the trading plan, but this is actually useful psychologically. One of the things that I did, so anyway, those are a couple of examples of what happens when greed and euphoria kind of get the best of you, right? One of the things that I'll do, two of the things that happened to me that helped kind of make the jump from corporate life to trading full time. One was doing like that gap play like that. That was like a very solid trade for me, and I'll show you a couple more setups. But the other thing is I set up an account. I decided that at the time I had $200,000. And I put $168,500. I don't know why that amount. I think it was because it was a Fibonacci. Yeah. Into my trading account. Okay. And at the time I was doing mostly options. And then I had the remainder in a savings account. Okay. So that was my full trading funds. Then what would happen is at the end of every week, if I had profits, I'd wire them into my trading account, my savings account. If I had losses, I'd wire money out of my savings account into my trading account. So I would start every week at 168.5. Then what happened is that I never started the week. I started every week at ground zero. I wasn't trying to make up losses. I didn't have euphoria from too many profits and playing with house money and stuff like that. And that was a really good, I think, psychological thing for me and got me to the point where, it helped me get really, really consistent with that. I know some traders who do that every day. Every day they want to start at $50,000. So every day they just wire money back and forth like that. And it's helped them. Something to think about. These days, I'll talk about it in more detail. I usually do it quarterly. But that was something that I did that for 3 years, and it helped me quite a bit. And I think psychologically it helps because you realize that you're actually doing this for money. And, it's not a game. It's not it's not like a video game where there's numbers on the screen and stuff like that. I actually would have the broker cut me a check instead of doing a wire, so I could actually get the check in my hands and, make sure, feel it and stuff like that. And it's kind of fun. So yeah, the thing here about it, when you have euphoria, what happens is generally you trade bigger. You start doubling up on your positions. I equate this to like, being in a loving relationship with your spouse, and hey, let's make things more fun. I'm gonna start dating another person as well, and it's just like doubling up on your positions and doubling up on your love life. Usually isn't gonna work out too well for you. So here's some just random things, and these are things that we've talked about and themes that you're gonna hear through this entire week. The first thing that you can do that's going to help you quite a bit is you're going to be your most objective before the trade is placed. So set up your parameters before you place the trade. Once you're in the trade, it's kind of like traders are kind of the best salespeople in the world. What happens is when you're in a trade, you can talk yourself into anything. Okay? If the market's going down and you're long, then you're going to find some excuse that it's a buy. Okay? If you were flat and objective, you'd be looking at it objectively, but because you've got a position on, you're going to try to find some way to rationalize what you're doing. And it's going to increase in direct proportion to the amount of contracts you're trading in relation to your account size. If you've got one contract on in a $100,000 account, you're going to be pretty laid back and pretty objective. If you've got 10 contracts on in a $10,000 account, you're going to be sweating every tick. So the way around that is to put your parameters on. This is why the ninja traders are so good, because as soon as you get your trade on, it places the parameters for you and gets you out of that situation. Successful traders that I've seen have the habit of scaling out of positions. Okay, get into a position, as soon as you start getting profitable, start taking some off. One of the things that Hubert and I like to do with our day trades is mechanically we'll get out of, on the Dow, if we're up 10 points on the trade, which isn't a huge move, we're just taking off half. And that's one way to reduce the risk-reward ratio. What happens is now you set up a lot more scratch trades than losing trades. You get out of plus 10 on the first half, you can raise up your stop a little bit, and all of a sudden now you have a potential for a small profitable trade and not a losing trade. So you start scaling out as the position goes your way. I scale out half and half. Hubert scales out quarter, 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 quarter.
Half, quarter, quarter.
Half, quarter, quarter. So it's kind of up to you on that.
What if you're in a situation that you're only trading a couple of contracts?
Half, one and one.
Yeah, half and half. I mean, that's what I just do half. There is an advantage in trading at least 2 lots. I mean, if you're a 1-lot trader, that's fine. It's the same thing. You just want to set up specific parameters and things like that. But if you can get up, if you're trading 2 lots, you do have the advantage of being able to scale out like that. Also, too, it's you just want to stay objective. A couple of people have told me that, like when the London bombings went off, all of a sudden their whole bias was totally bearish on the day, and everything they did was short, short, short. Even though it was like, it doesn't. You just got to see what the market's going to do and take the setups that they're going to get you. You just want to be careful with that. There's always a saying: it's discipline before vision. You may have a vision of the market going down 500 points, but have the discipline to put your parameters and stops in place first. Biggest differences I've seen between professional traders and amateur traders. Professional traders focus on limiting risk and protecting capital. Amateur traders focus on how much money they can make on each trade. Okay? In that situation, what happens? Professionals take money out of amateur traders' accounts. That's how it always has been and always will be. Amateur traders turn into professional traders once they stop looking for the next great technical indicator and they start controlling the risk on each trade. So I can't emphasize that enough. If you guys learn anything here this week, if you can go out and put your stops in place and stick to them, you're going to be ahead of 90% of the other people out there. Remember the guy with the $100 million inheritance, the guy with the $10 million hedge fund. Those are guys that's money that's going to flow into your accounts by having the discipline to set up your parameters before you take the trade. I've kind of already talked about this. If you're in a trade, you embrace your own opinion on the markets. What's going to happen is you're going to see the market through your point of view, not objective. If you think the market's bullish, everything you see is going to be bullish. If you think the market's bearish, everything you see is going to be bearish. Just really be careful of that. I think the other thing too is that you need to kind of celebrate your small losses. If you take a small loss, you are a professional trader. Okay. Everybody gets bent out of shape. It's like, oh, this trade didn't work out or anything like that. It's just part of trading. It's not a big deal. Always remember that you're not actually trading another stock or options or futures contract. You're trading another trader. Someone else is taking the other side of the trade and they're betting that you're wrong. So keep in mind, is the other person on the other side of your trade an amateur who is chasing the market or who just got in at the wrong time, or is it a professional who's been waiting for that level for a long time? It's just something to always keep in mind. Someone's betting against you every time you trade. I think the most important lesson in becoming a successful trader is just learning how to accept a loss without any frustration, anger, or shame. Okay, there's no reason. If you get stopped out 3 times in a row and it just ruins your day, there's no reason for it to. You're doing your job. If you get stopped out 3 times in a row and you only lose 2% of your capital, that's what George Soros does. Okay, you're doing the same thing as George Soros. He's got a saying where he says it's like, it doesn't matter how many losses you have, as long as they're small, and if you only have a couple of winners and they're big, you're going to be fine. He usually has a win ratio of like 30%. He gets stopped out, but then he catches on some trends and he just rides them out. Okay, he does pretty well. That's a different story.
I don't know.
We're not even going to go there. Let's see. Yeah, and I think what's going to happen, and you'll find, is that if you start following the rules and you start placing your stops and targets every time, all of a sudden you're able to trust yourself as a trader. You realize you're not going to put yourself in a situation where you screw yourself, okay? Because too many times you get into a situation, you freeze on the stop, you think it's going to come back for you, and all of a sudden you have a day that you lose 20% of your account. If you know that you're going to follow the rules each and every time, all of a sudden you're going to be a more relaxed trader. You know that there's nothing that's going to happen that's going to hurt you too bad, and you're going to be able to make more objective and detailed decisions like that. Just a couple other things to remember before we wrap this up. Just focus on developing your skills and focus on following the setups. Don't focus on the money. Too many traders put together their plan and it's like, okay, I'm going to make $200 a day. I want to make this much a month. It's going to be this much a year. That really shouldn't be a big part of your plan. You need to focus on the setups first and see what type of return those setups give you. Once you notice that, then you can start planning for different things like that. But if you just start focusing on the money, all this other stuff goes out the window. Also, too, the less you care about being right or wrong, the easier it's going to be to enter and exit positions. If you have a habit of not being able to pull the trigger, what's happening is you're scared to be wrong. Okay? There's no reason to fear that. You just get in a trade and put on your stop and let it work out. If you realize that if you get stopped out 3 times in a row and it's not going to be a big deal, it's not going to be a big drawdown on your account, you're not going to be afraid to pull the trigger. Okay, so that's the psychology portion of this. So any other questions on that? I kind of wanted to just go through that just so you guys, because when we go through the rest of these setups, it's going to be very important for you to remember that, just to kind of remember that in the back of your mind as we take the setups. Because we can show you the setups all day long that have worked well for us, but if you don't have the discipline to follow them and to follow stops and things like that, they're not going to work for you. Okay, so these two go together. You got to be able to understand the setup and see how it works, and then have the discipline to follow it the same way each and every time.
Talk about taking profits at, say, 10 points. What do you do to try to take away where you talk about running the trend? I mean, you're not running a trend when you're taking a 10-point profit.
Okay, it's good question. The question is you're talking about playing the trend, but if you're only taking 10-point profits, remember it's 10-point profits on half, and then letting the rest go on a lot of these setups, which you'll see. Okay, so it's based on just the trading that we've done so far. We've done it before where it's like you get all in and just stay in the entire position, and you have the risk of coming all the way back down and getting stopped out, or you know what, we got 10 points, let's take some off, and now we've got less risk on the second half of the position. On the second half of the position, if it does turn around and you get stopped out, it's a break-even trade instead of a losing trade on a full position. It's a little bit different with day trading than swing trading. Most of what we're talking about, 10 points here, is on day trading. If I'm doing a swing trade, I'm not going to get out at half at 10 points. The swing trading setups are things that we'll talk about later, though.
Instead of getting out half at 10 points, why not just move your stop break even once you move up to 10?
That's a good question. Okay, the question is, instead of getting out at half at 10 points, why not just move the stop to break even? I've actually tried that, and a lot of times what happens in that situation is, you end up getting obviously just get it. I don't like the stop being too tight. Like when I get out at plus 10, I don't bring up my stop to break even. I actually bring it up to entry minus 10. So by a scratch trade, I mean I would make 10 points on the first half and lose 10 points on the second half. I found that gives more of an opportunity to stay in the trade longer, whereas just as soon as I'm up 10, bringing it up aggressively from a 20-point stop to break even, it kind of gives the trade a lesser chance of working out.
Do you try adjusting your stop, instead of moving up to break even just to 3 points below? See if that.
Good questions, but honestly, once I get into a trade, I don't want to manage it that much. I just want to let it work out. I mean, yeah, you could sit there and aggressively, okay, it's up 2 points, I'm going to trail it 2 points. I have done that with software programs where you can put the automatic trailing stop, and I have not seen the results being as good as just letting it do like that. So those are, in my experience, that's what I found.
Bill?
If doing that, taking off whatever you put your stop after taking it back, tests out very well mechanically, but it's also just a tremendous help psychologically. I mean, it makes a big difference if you have a problem with getting out too soon or whatever.
Yeah, I think it's, and that's an interesting point. I mean, I guess I probably haven't thought of it, exactly in those terms, and it's a very good point. I mean, I think it's the habit of, hey, I've got a plan, I've got 10, ringing the register. It's kind of, as a trader, that's what you want to do in making profits like that. And I think that, once you make your first 10, it actually gives you more leeway to make more on the second half. That's a good point.
Psychologically, you're not so worried about losing everything, winning a lot. You've already taken some profit or made sure you break even.
Sure, that's a good point.
You're much more objective from now. At least I am.
That makes sense.
Most people I've talked to.
Yeah, because most of the setups you use in mechanical systems, it's half and half and things like that.
It tests out very well, but also if I'm trading it myself, and Mark Douglas talks about this too, that it really helps you psychologically. If you've already taken some profit or you are guaranteed a break even, you're much more objective on the second half or this.
Sure, absolutely. It's all good.
You can just look at the market and say, do what you're supposed to instead of you. Because one of my problems is taking it off too soon, right?
Sure.
Taking profit too soon. And not letting him run.
No, that makes sense. All right, we're gonna go ahead and do is let's take a quick break, 10 minutes, and then we'll come back and do the rest of the half.
Anybody have any questions on what John just covered about the trader psychology? Nothing. All right, so I'm gonna start going over the squeeze plays. All right, squeeze plays are pretty easy to understand. Now, the way I teach the squeeze plays is so you know how they were developed. In the indicator, what's going on. So like if you have another data feed or something like that, you can totally reprogram them. We do have them for TradeStation. We do have them for eSignal. But I'll show you a way that you can build like a poor man or a dirty man squeeze, okay, and it'll still work, all right? So squeeze play, all it does is it just measures the strength and the direction of the move. How the squeeze plays work is it's a measure of volatility, okay? I'm not going to read this. I can't do it. I can't do that stuff. I'm just going to tell you, and you can read through the slide or in your manual. I'm going to describe it how I would normally do it. What the squeeze play is it's Bollinger Bands and Keltner channels with a momentum oscillator. Now, in the bottom of my histogram, I've got a couple other things going on. But the main thing what it's doing is it's looking for volatility and then contraction, a sideways move, and then volatility again. So what it's doing is it's measuring expansion and contraction of volatility, okay? So that you don't have to stand there and sit and stare at the chart and go, oh, volatility is expanding. Oh, now it's getting a little tighter, so I'm going to have a trade set up, all right? So it measures the relationship between the Bollinger Bands and the Keltner channels, and it works on a bunch of different time frames. Let's just get into the meat of it. I hate reading word for word. So in this first chart example on page 255, all right, you have with what is just the Bollinger Bands, okay? Does everybody pretty much know what a Bollinger Band squeeze is? All right, a Bollinger Band squeeze is just, this is when the volatility is expanding, and here's where it's contracting, and then boom, it expands again, okay? So the first thing that you look at, and this is how you actually find like playable stuff too. Like when you're sitting there and you're staring at stuff and you're looking at just a basic indicator, your job as a trader is you're like a weatherman. You're trying to predict patterns, try to recognize patterns, and you're like a risk manager of an insurance company. Like you look for pattern recognition, and your other job is to manage risk or assess risk. So the first thing on the Bollinger Bands, I started seeing a pattern like, okay, when that happens, then you usually get a nice little volatile pop afterwards, okay? So now here's another example. But it looks a little bit different, right? Because in this example, the expansion of the volatility is not as big as the other big balloon was, all right? And now this little tight squeeze here lasted a shorter period of time, okay? The big thing is, I had a problem saying, okay, how do you measure the squeeze of the Bollinger Bands? Which ones do you take? How will you filter it out? I mean, you can't just take every one, because sometimes they would work and sometimes they would not, okay? So this is the definition. So if you need to build it for other data feeds, you can. All right. So what I did on page 258 is I threw the Keltner channels on top of the chart with the Bollinger Bands, okay? So now, as a rule, I can only classify a squeeze as when the Bollinger Bands go inside the Keltner channels, okay? So now I at least have a way to filter out which squeezes I'm going to take or not, okay? So I'm not just going to blindly go, oh, it's tight. And so now I have a measure of how tight is tight, all right? So as you can see here, the Bollinger Bands are in blue, and the Keltner channels are in red. And pretty much the Keltner channel, he's the first guy that came up with like the band thing. And then Bollinger, he added the volatility thing. So it's kind of like, and there's nothing new in trading. Everybody just copies everybody else or steals their material and makes it their own. Swear to God. I mean, the momentum also, that's cheating. That's how it works. I mean, you find something that you've read in a book or you went to a seminar or some indicator, you figure out how it works, and you either go, I don't like that, or, oh, I like that, I'm stealing that, that's a good idea. And you just make it your own and put it in your own trading plan. And it either works for you, it doesn't, but it has to kind of fit your style and your personality, okay? So that's what we're looking for here now. So now we know that's a squeeze. And then, so when the blue line goes inside the red line, that means when I yell out in the room, I'll say, okay, the squeeze is on. We're going into a squeeze, okay? And then I don't fire off a trade until the blue lines come back outside the red lines. So when the Bollinger Bands expand and come back outside the Keltners, that's when I want to trade, all right? So now the second question I had is like, okay, they come out. Now, how do I know whether to go long or short? Because I had a way to filter them out, but I didn't know a direction, because it was still like a 50-50 proposition for me, all right? So here's another example. So the last example we just looked at was a long, okay? So now here's another example. Bollinger Bands go inside the Keltner channels. Bollinger Bands come outside the Keltner channels. Boom, you get a pop-up, right? Here's another little move. Bollinger Bands go inside the Keltner channels. Boom, come outside of Keltner channels. Boom, you get a down move. So what was frustrating to me, I was like, okay, this one said this one went up and this one went down. So I had to add another filter mechanism to kind of figure out which direction it was going to go. I just use momentum. If momentum is above zero when it fires, when it comes out, I go long. If it's below zero when it's coming out of the Keltner channels, I go short. So even if you don't buy the squeeze from us for like TradeStation or eSignal, every program on the face of the earth, if it's worth anything, will have Keltner channels, Bollinger Bands, and momentum. I mean, there are three really simple oscillators or indicators or whatever you want to call them. So now let's take a look at an example. All right. And the real reason that I hired a programmer is I found some free source code that kind of resembled the look that I was looking for, and then I hired a programmer. I was like, I like the look of that, but using these three things here. And then I just messed around with the histogram thing to make it a little bit better, to fire off an audio alert when it's either going in the squeeze or coming out of the squeeze, and for it to make it real easy for me to explain when somebody goes, when's the squeeze on? So I've kind of changed some of it a little bit, and I'll show you up here on my screen. I make it real easy where it's red light, green light. So red light, get ready, green light, go, and then blue is up and red is down. So even if you don't have TradeStation or eSignal, what you're looking for is this right here. Blue lines go inside the red lines. Bollinger Bands go inside the Keltner channels. And boom, when they come out, you just look down here at momentum. Is momentum above or below the zero line here? It's above. You go along. All right? Now we go along this signal here. Bollinger Bands go inside the Keltner channels. They come out. You look, is momentum above or below the zero line? It's below. You go short. Does it work every time? Obviously not. You have to still use market internals and market direction. Okay? But at least it'll give you, it makes the decision process a little bit easier. Okay? Here's another example. Total different look. Look at these two. Look at this chart, and then look at the one that we're looking at. You see how the difference in the Bollinger Bands? How they're, some of them are way out here, and then they come back in tighter. So it's a different look. The best thing about it is it'll filter out the moves for you, so you don't have to freak out too bad about it. Bollinger Bands going along. This is a 5-minute trade. Come inside of the Keltner channels, trade sideways. Then they come out. As soon as they come out, you look and you see where the momentum is. It's above 0, you go long. You go long right here on this bar, and you got a pop from anywhere from 102.40 up to about 102.80. So about a 40-point move. Okay? Now, this is just a definition of how the indicator works. I'll explain it on this next slide. So I got tired of looking at all the lines because they'll make you go cross-eyed. I mean, there's a lot of lines on that chart. So it's a much easier. I just paid an indicator guy, a trade station programmer, and an e-signal guy. So now anytime that the squeeze is on or we're in a squeeze, I get red dots, okay? So this red dot here tells me that the Bollinger Band, it went inside the Keltner channel, and then boom, right here it came out, okay? So there is a long signal. This is on a 5-minute. That's a long signal, and that's a short signal, okay? Anybody got any questions on how it works? Yes?
How do you get your green dots to line up straight across?
It's just in the indicator.
Yeah, but I have the indicator too, but mine...
What version do you have?
Yeah, it's 3.1, they start to line up.
Yeah, we had a lot of people complaining about that because there's no difference in it at all. It's just a look. I mean, it works no better or no worse, but a lot of people were complaining like, mine's not straight like yours.
Yeah, I just got mine.
What market are you putting it on?
ES.
ES? It should work. 3.1B and above has just the straight at the 0 line. Now, there's also an input. You might want to check your indicator, make sure that it's set up for a future, because we've got it set up 3 different ways: for a future, an equity, or for Forex. If you've got it on a Forex and you've plotted it on the ES, it'll have that it goes like this. Just have Priyanka set you up on Go to My PC, and one of us will log in and check what your setting is for you. Okay?
When you use this on the equity indices,
Yeah.
do you do the Globex session in 24 hours or just the day session?
Say it again.
When you use the squeeze indicator on the equity indices, like the futures.
Oh, yeah, 24-hour time frame, yes.
24 hour.
24-hour time frame, yes. Yep.
How do you determine your exit?
I scale out on everything. The same way I explained on the gap is the exact same way I exit every other trade. I don't vary it any. Like it's a 10-point stop, 10, half, a quarter, and move those stops accordingly. I mean, on any trade setup I do, I still mechanically exit it the same way. Because I'm not the brightest, sharpest axe in the tool shed, so I keep it the same. So I have to say, what are you doing? Same thing. What are you doing with this? Same thing. Yeah.
Is there enough volume to make that work?
Is there enough?
Yeah, 24 hour.
Oh yeah, sure, yeah. It'll work. But now I don't personally recommend anybody trade Globex. But yeah, I mean, there's enough for a signal. Huh? Oh, okay. All right. The question was, is there enough volume on Globex to fire off a trade on the indicator? Yes, there is, but I do not recommend that anybody trades Globex. But yeah, it'll catch some good moves. Question?
What is the difference between the future stocks and FX with this setting up?
There's no difference. It's just how the data vendors do the increments. Like Forex has a different numerical increment than do futures. Like futures are traded in 1 lots and above. Stocks, 100 contracts or above, and then FX is in pips. Don't ask me. I just know the programmer said, listen, it'll look better to the eye for the scaling if you do this. And I was like, okay, do that.
The blue on the top of your green dots, what's the significance again of the blue changing from one color to the other?
Nothing.
Why is it?
I mean, I don't use it.
What's it for?
This is, okay, red dots mean you're in the squeeze.
Okay.
When you're coming out of the squeeze, you have a red light, green light. Green light means go.
Okay.
Blue means you go long.
Right.
So this would be a long right here.
Right.
And then here you have a squeeze that fires off. All right, I'm going in the squeeze here. and then I'm firing off a squeeze. It's going enter the market short right here because it's red. Now, the question I'm going to get, I guarantee it, is, well, okay, the indicator looks like if it changes from red and then goes to blue, that's a signal too. Okay, but I don't use it that way. I mean, a lot of people use it that way and say it works. It's just not my thing, but you can use the histogram that way. The histogram, all it is it's a combination of the momentum indicator, and then I had my programmer, I didn't like, the momentum wouldn't keep me in the trade long enough, so I had him add like an ATR and a couple other little indicators. They're nothing special to them though. It's just, it keeps me in the trade a little bit longer. So, I mean, I've given you the Bollinger Band and the Keltner and the momentum. It'll get you by good enough. The only thing, it's direction. The only thing is your histogram's probably not going to look as pretty and as accurate as mine because I added in ATR and something else. I'd have to look at the code and see exactly what's in there. There's nothing special about it though.
If I buy your indicators, are you telling me when to get out there too, or give me?
Nope. I mean, I'm gonna go through some warning signals that you can go through. Question was, will the indicator also tell you when to get out? No. I mean, it's an entry tool, and then it'll give you some warning signals as, listen, this move could potentially be over, so heads up. Okay. But remember, the underlying premise is you have to learn you have to know how to read market directions and market internals. If the market internals and market direction are just screaming higher and the thing fires off a squeeze to the downside, you pass and take long signals, okay? All right, so here's another example on a 5-minute chart. So on this one here, we're going along. Nothing, 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 nothing. And then we get to our first red dot, which means, all right, pay attention. I'm in the squeeze. I could fire off on the very next dot, or it could take a while. So in this case, it actually traded sideways for quite a long time, and then boom, it fires off a green dot, which means, all right, I'm coming out of the squeeze. And since the histogram on this indicator is blue, it means in this one, I think it's going higher. I think the market's going higher here, okay? So the long signal's here. Now, here's one thing you can use. It won't tell you where to get out, but you see as long as the histogram keeps its same color here, it means the momentum is making new highs, okay? As soon as it changes color from bright blue to dark blue, it means heads up, I'm potentially running out of gas, okay? And just on this particular example, it caught it pretty good. It did not catch the dead low. It did not catch the dead high, but it got the meat of the trade from right here to here, okay? Another thing you can do is also, and I'm going to go over this one next, is the TTM. So does everybody understand how to use the squeeze and how it's made up and how you can have it programmed for other stuff? Go ahead, you're first.
Just about your alerts. I have your squeeze,
Mm-hmm.
but the alert only fires off when it goes into the squeeze. How do you make it fire off when it comes out of the
I don't know what version has it. I've got so many versions of it because I'm always sending it off to a programmer, seeing if he can add or take away stuff just from a user standpoint. I know there's one that'll fire off when it's coming out of the squeeze, and I think 3.1b and 4 only fire when it goes into the squeeze. I think version 5 might have it where it fires when it's coming out of the squeeze for the actual signal. I'll just have to double check when I get back to the office. Only two I have on my laptop is 3.1b and 4. They just fire when it's going into the squeeze.
If you miss the first green, you recommend it better to wait for the next one, or there is a way that you can...
Question was, if you miss the first green dot after a series of red dots, do you just pass on the signal, or do you take it? It's total a personal preference. Some people like to take it as soon as it fires here. Some people like to do it here. I personally will take it as soon as it fires off. Now, there are a couple things that you can do. Let's say that the first signal, which is a series of red dots followed by a green dot, okay, which means there's the signal, and if the histogram's blue, you go long. Let's say you missed that first signal and the market ran, okay? What I would do in that case is I would wait for the ticks to come down a little bit, and I would buy the first tick hookup in that case. Yes, correct.
Okay.
I'm going to kill you with examples. When you get out of here, you will definitely know how to use the squeeze.
I just want to make a comment about having your chart set up where it either just displays intra-bar.
Oh, okay.
Or, remember, I got so screwed up on this.
Question is, in TradeStation, I don't know about eSignal, but there's a way where you can make an indicator fire off intra-bar or when the bar closes, okay? Okay, if you have it set to fire off intra-bar, then the dots will blink. Like before this thing turns green, it'll go red, green, red, green, red, green. And you'll have a tendency, if you don't really know how it works, you'll be like, oh God, it's green. And you'll jump in, and then it'll go right back in the red dots. So for people just starting out with it, have it set to the close of the bar so you'll know, okay? All right, so here's another example, 5-minute squeeze. We're going along here. Nothing, green means nothing. Series of red dots means get ready. First green dot after a series of red dots. You can go on one red dot. All right. The histogram is pointing down, it's red. So there's a short signal about right here. Now as we're going along, you can see that the momentum on the trade kind of ran out right here. It changed colors. So it's potentially saying get out. But in this case, the market did continue lower. So that's just an early warning signal saying, hey, heads up, I might be running out of gas here. You can either take some of your profits or hold on, but at least I've warned you about the momentum running out on the trade. All right. And then here you have another one. This one actually, I'm going to go over this. This is what we call a total momentum reversal, and I have a better example of it. Okay. Here's another 2-minute chart. Same stuff. It's really simple. I mean, but the way I trade is I'll do the same exact thing over and over and over and over again. I know you guys, like when you're sitting up here going, well, yeah, but do you use this? Just not my thing. I try to keep stuff really simple and repetitive. It's just like I work at a factory. They're like, you know, what, you don't use moving averages, or you don't use this, or don't that. Just not my thing. All right? I do the same thing every day over and over and over again. It's really boring. It's not sexy at all, but it works for me. All right? So here's another example. Going along here, 2-minute squeeze. Fires off a red dot, green dot. So it fires off a short about here. Then you go along again. 2 red dots means get ready. Then you fire off a short here, a short here. Another thing you should be picking up on, you notice how the TTMs are red? All right? That's kind of a signal too. I mean, I kind of like 2 confirmation things. So like here, it's saying, okay, I'm running out of gas, but the TTM's saying, no, I think you're okay. But I mean, you just have to learn like how to use it. Like I scale out of everything, okay? So I'm probably out of 3/4 even before it gets to here. All right? And we'll go over the mechanics of that in just a little bit. Does anybody have any questions on it so far?
Yes, and what's the red dot in between the greens? I didn't get what to do. You just hold the entrance there?
What's your question again?
At the beginning, the red dot in between the green, no, the other one. The other one.
Yeah?
Yes.
Okay, so there's no signal here. This is your first signal. It says, okay, I just went inside the Bollinger Bands. And then in the very next bar, it said, okay, go short now. It fires off a short about right there. 1 dot is good enough for the signal. Red light means stop. Green light means go.
Does the depth or the height of the momentum mean anything to you?
It doesn't mean anything to me.
Oh, I see. Well, here you have a divergence. The example on 268, you get 1 red dot, and then you get a blue, and it's still blue at that point, though it's fading.
Yeah, that's called a total momentum reversal. We'll go over that in just a little bit. All right, so here's another example of a 2-minute squeeze. Now, the first one I showed you on a 5-minute did not work. I cannot stand going to seminars and going, oh, here is a perfect example of this, and you caught the dead bottom. It doesn't happen. I mean, what the thing is designed to do is catch the meat of trades, okay? It's never going to get the dead low. It's never going to get the dead high, but it'll give you your meat in the middle, okay? And it does fire off false signals, just like anything else. You got to have market internals and market direction first, okay? Any indicator will work for you if you know how to read market direction and market internals. Question?
When it's firing off and it's doing those little dips and coming in and out like that, you just stay away from it?
Well, if it's doing that, you should be picking up on the market internals are telling you that it's a choppy day and to sit on your hands, okay? The question was, when the oscillator or the indicator is firing off sideways, it's usually an indication that the market's trading sideways, and you should be picking up on that with the stuff that we talked about yesterday, like the trend, the ticks, the put call, and stuff like that.
What do you mean by firing off sideways?
It just means you'll get a signal that'll fire and it won't go anywhere.
Oh, the marker won't.
Yeah, it won't move.
Jack, go back to the previous slide because I don't think we discussed this.
Okay. All right, so here's another one. 2-minute squeeze. Nothing going on here. No trades, no trades, no trades. Boom. You get a squeeze to fire off. It goes into the squeeze. Here's one thing that you do need to kind of look at. It's the angle of the momentum, okay? The angle of the momentum. You see how this histogram had its low here? You see how it's coming up here? And it fires off a short here. Do you see where the histogram is going higher? It means that I'm going to fire in this direction, but it's probably not going to work, okay? It's the only thing tricky at all about this indicator. It's saying, listen, it's kind of like a momentum reversal. It's going, I know I'm firing a short here, but I'm really going to go the other direction. So just pay attention to this right here. And the most powerful signal you can get is when you get let me back up. I think I've got another example of it better, but when you fire off a short, you want the momentum oscillator or the histogram to be making a higher high or a lower low. It doesn't always happen, but it usually happens. When I see this signal right here, I go, yeah, that's not going to work right there. 9 out of 10 times, or 8 out of 10 times, or 7 out of 10 times, that's not going to work. Because now if this would have fired off and I would have had a green bar here, oh yeah, it's a good signal. All right. So this is one way to kind of filter out signals that fire off incorrect.
Can I put that squeeze play on a regular candle bar chart as opposed to the TTM chart?
Question is, can I put the squeeze indicator on a regular candlestick chart? Yes, you can.
Okay.
Yes.
Would you play long? Would you play long there?
The question was, would I play long here? I would actually probably just pass on it. But another thing that you can look at, I would probably pass. You had this saying to go short, and this was still red. As soon as this went blue, that would have confirmed that was a bad signal. And you also knew it was going to be a bad signal with the histogram kind of coming up out of the depth here and going to the other side. All right. I would have probably waited and taken this long here. Now that says probably. I cannot stand people that do the hindsight thing. I'm terrible at hindsight. I mean, I could sit here and tell you, yeah, I would have bought here and I'd have sold here. I mean, it just doesn't happen. I hate people that stand up and go, well, I would have bought right here and I would have sold right here. I'm better in real live market conditions than I am sitting there going, here's what I would have done today. So here's another good signal. So first you had this one that you should have filtered out by looking at the momentum and going, all right, pass. Then you get a good one here. You have a long signal that fires off along here. Momentum increases. Doesn't change color until about right here. It catches you a pretty good move. Okay? It's a 2-minute chart, so it catches you a move from about 105.20 up to about 10600 or 106 even. And then it did actually go a little higher. All right? Now there are some people, and they'll ask it in the room, why don't you just short here and then just cover when it changes on the red? Just not my style. I just don't do it. But some people do use it and have success with it. Okay? This is just a classic day where it's catching a really good down move multiple times. Okay? It's a 2-minute chart. You get a short here, here, this one here. Why do you not take this one?
Increases the momentum.
Angles in the wrong direction, right? It's kind of like a divergence thing. So you just pass. All right. Short signal here. Why do you not take this one? Same reason. So now you know which ones to take, and you know which ones look a little questionable. Okay. Now, could you have went long on this one and made some money? Yeah, a little bit, but why? Because all the market internals and the market direction is screaming, I'm getting killed, I'm getting killed. Don't be stupid. Do not take the other side.
So are squeezes that set up with like 20 dots more powerful than ones that set up with 1 dot?
That's a good question. No, a lot of people ask, they'll say, okay, if there's like 50 red dots, is that more powerful than like 1? I don't have any statistics to support that it is either better or worse. I've seen one dot run 80 points, and I've seen 15 points run 100 points. So
all
I don't have any.
The Bollinger Band was just extremely tight inside the Kelvin channel, right?
Yeah, it just means it's consolidating longer is all it means.
And it seems like, common wisdom would say that, the longer it is, the more powerful the move would be. And I used to actually think that. And I've just seen, 1 dot moves last just as long and just as powerful as 40 dot moves.
It just all depends.
Do you have any stats on the average move for certain types of markers?
Question is, do we have any stats for the average size move on the squeeze? I do not.
Surprisingly, it's not there. Every squeeze is like one day it's going to be like a 5-point move, the next day it's going to be 80, and I've never seen anything that correlates with that. So we just take them.
Do you take the same exit strategy you guys do?
Well, no. Huber's going to go through his, and he'll do his exit strategy, and I'll tell a little bit more about how I use it. I actually use it more kind of for swing plays, and I do some intraday stuff with it in conjunction with pivots. And when I do that, I'll talk about those.
Work as good with the ES? Excuse me. Does it work good with the ES?
Yes.
Question is, does it work good with the ES? Yeah, it works. The squeeze, the basic concept of the squeeze, works on about 70% of the markets. About 30% of the markets, it'll get you killed.
An interesting fact, here's an interesting fact on the ES is that when you actually back test it on the ES, you get a better P&L curve than with the YM. Like if you do that, like on TradeStation and stuff.
You mentioned in the book one time you used the 2 and then you used the 5. If somebody's using the 1 minute bars, would that affect the outcome? Is it designed for 2 and above? No.
The question is, what time frames? You're saying in the manual use a 2 and a 5, but can you use it on 1?
You said in there to sort of imply.
I'll go over time frames in just a little bit. On the ones that I prefer and personally use, it works on a ton of different time frames. It's a personality issue. It's a trade style issue. The squeeze works really good on about 70% of the markets. On about 30% of them, it just does not work at all.
And there's a really easy way to find out. You just bring up a chart and put it on there, and if 7 out of 10 trades, if at least 7 out of 10 trades on the squeeze would have worked out, you're good to go. If you it's really weird. If you put it like on Microsoft or Intel, like on a daily chart, it looks great.
It's like 80 or 90% of the time, it's either on Intel or Microsoft. We'll pull it up on chart. On a daily, it's either Intel or Microsoft, it's like 90% accurate.
But then if you put it like on 3M, it's nothing.
If you put it on Clack, it'll lose you money.
Currencies, we'll show some examples of currency trades in a little bit, but yeah, I use it for currencies, especially like on daily squeezes and stuff like that.
You work on commodities?
I've used the squeeze on the grains. I haven't tried it on like palladium or anything like that, but it seems like things like gold.
You can trade palladium? Is it palladium or platinum?
There's both.
Oh.
Ethanol futures.
Oh, shit, really?
Yeah. That's a good market for beginning traders, ethanol futures. That was a joke. It works really good on gold, the grains, the different currencies and things like that. But yeah, just as Hubert said, if you put it on a chart and just look at it, you'll see.
Go ahead.
Did you just say a second ago that it backtests slightly better on the S&P than it does on?
We ran some back tests on it, and if you're like for auto trading and stuff like that, the S&P actually had a little cleaner equity curve. But intraday, I traded on the Dow intraday. It's just one of those things. Like if you did it for a year, mechanically without any of your filters or anything like that, it was a little cleaner on that, but not by a big margin. Intraday data, 5-minute chart.
Now, Hubert, if I understand it correctly, you caught that long move down, that move from about 10,450 down to about 10,003, right?
Caught that. That
I was actually on this day. I was micro scalping on this day. A lot of these examples, like when you're teaching and stuff, you just kind of look for stuff that looks really good and is like perfect setups. But I'll trade it. I traded it live this morning. I traded every day live in the room. But I actually bought. When I was micro scalping, I was short through some of this stuff in the morning, and I had already caught, I think, 30 or 40 points or something like that, and then I was flat. And then something happened, the market freaked out, and I ended up getting like long up in here and got a piece of the move. Somebody did something and had a bad they busted on this day. I think they busted some of these orders. That was the day busted orders? Yeah, they busted orders on. It was a bad tick and stuff. You can only get like a fill up here above 103.51 ish. So yeah.
So how can they do that? How can they cheat?
Those damn cheaters.
Damn cheaters. They'll bust orders. I mean, you listen to the pit. They'll bust orders all the time. They'll be like somebody will want to print at a price, and the local will be like, no, and then they'll bust that order.
In the last 5 years, I've had 2 orders busted. I mean, it doesn't happen very much.
So, yeah.
Both times I was upset.
Busted meaning?
Meaning that I remember when I was short the Dow like 10,400, and somebody came in and like accidentally hit 10,000 lots instead of 100, like on a trade, and it drove the Dow down like 600 points, and I caught like 500 points of it. And then the next morning, instead of being out at 10,100 or whatever it was, they changed it to 10,480.
Well, that's...
Thank you very much. Thank you, sir. May I have another?
Trade
yeah.
Question?
One of the reasons, two quick questions, is one of the reasons that this works is that momentum precedes price.
I don't know. I don't really. Well, one of the reasons this works is it's a volatility play, or it's a lack of volatility. Volatility is followed by lack of volatility, which then makes volatility again, okay? Market moves in. A lot of trading is just sitting there. Like 60% of the time, you're just sitting there watching stuff, waiting for a move to happen. So, I mean, that's all this does. It kind of gauges you like, hey, pay attention now, might get a move. All the momentum is doing is going, listen, on this little volatility expansion, I think it's going higher, okay?
It's also good if you're an impatient trader, because like a lot of times, Bob, a lot of times the market will be consolidating, and you anticipate it, and you try to get in early, and then you'll sit there and you'll wait for 2 hours as it's consolidating, and you just get out of the trade. The squeeze is telling you when the consolidation's over. So it's good for people that, if you can't be patient, wait for trades like that, it's telling you it's over and it's time to jump in.
Volatility, you mean the money and the amount of...
No, volatility just means how fast and how violent price actions move. Does that mean?
How does that work?
Like this.
Okay. We're going to fly.
Yeah.
Do you have actual statistical results on using it on Dow?
No.
We don't have stats on this like we do on the gap. The gap data is actually easy data to get. This is the only data that we have is from our own actually trading it. For the years and years of going through and I'll talk about how I do this on the business plan part that we talk about. But it's just really looking at a squeeze setup and doing it this way it yields X. Doing it this way it yields X. And so it's kind of our own trading experience.
Can you use a rate of change indicator instead of your momentum?
Question is, can you use the rate of change indicator as opposed to the momentum indicator? You can use whatever the hell you want to. I mean, it probably worked fine. Rate of change, a percent R, anything. I mean, something that'll kind of give you just it'll help you decide on the direction. Yeah, it should work. I mean, I don't use it, but you could. Anything else? All right, cool. Let's move on. Just more examples. I'm going to hammer you with examples. So at least my theory is the main things I want you to get out of the seminar is kind of have the basics of how to read market direction, market internals. If you don't know how to do it, you need to learn how to do it. It's the most important thing. And then I want you to walk out of here knowing exactly what the squeeze is doing so you don't think, oh, it's proprietary. There's some secret formula. So you know what the mechanics are. And then I want you to have a really good working knowledge of how to use it so that you see a lot of examples.
Just go over those blue dots again in the beginning, there in the middle. Yeah, right in there. No, back to the left. Right in there, yeah. Just.
All right, so the red dots mean stop. Okay. Green means go. And since the histogram is blue, it means get long, which the long is here. Okay. And then I scale out. Okay. So however many points you're going to catch on this, move on the daily. All right. This is a daily chart. All right. So now this one means, all right, stop.
What's that other one?
That?
What the hell?
That's probably a Sunday.
Okay.
That's just a gap in the data is all. All right. So now this is a daily. So then here we go again. Nothing. Get ready. Go. What's the deal on this one right here? What is this? This right here is one of the most powerful signals you can ever take on this thing. It's when it goes from red and then to blue. You see it in your manuals? Page 272. I call it a total momentum reversal, okay? It's where it goes from red histogram on the signal and then goes pow, blue histogram. All right? Make sure you got it in your head. Can you see it? First green dot was red. Second green dot, you might not be able to see it because it's real small. I tried to blow it up a little bit, but it has a little blue underneath the green dot. Because the green dots are superimposed on the zero line of this indicator. But trust me, on this signal right here, it's actually got a little bit of blue underneath it. And it's a long signal here. So you can see you caught a move from about, I don't know, 105, 80, and then it didn't lose some momentum up until about right here. So it caught you a move from here to about right in here on a daily chart, okay? Now, obviously, you're not going to catch the entire move, okay? But it does give you the opportunity to catch, several points on it, okay? How you scale out is kind of up to you. I'll show you how I scale out.
Would you use something like that if you're a scalper on a daily to give you, at the end of the close on that particular day, to anticipate the market direction?
Question is, if you're a scalper and you're trading intraday, how would you use this as on a daily chart? If I knew that the daily squeeze had fired off a long, then it would tell me, hey, if you're scalping today, go long, and you can do shorts, but I wouldn't be totally committed to them. Yeah. All right. So here's another one. What is this signal right here? We obviously have one red dot. It fires off a long, but what's the signal? The momentum's fading. All right. So I want to make sure that you actually know, so that when you get back home, you don't go, well, that was a bad signal. So you know how to handle it. All right. The momentum on this thing was going down, so obviously it's telling you it's not a long. This long is not going to work, and it's probably actually going to go in the opposite direction, which it actually does. Okay. What else on the screen is telling you that it's not going to work? TTM. The TTM is red up top. Okay. Here's another example. Here's a short, and then here's a long. Okay, and then we're back in another squeeze. Okay. Now there's a slightly different way for people that don't want to go on the first dot. If you look, and I don't have any statistics on this, but this is a pattern. If the daily fires, what you can wait is you can wait on the third or the fourth bar after the first dot fires off. If you don't trust it and you don't have the confidence in it, you can wait until the third or the fourth day, and it'll usually pull back for you. Okay, so after the first day, if you're like, it's bullshit, it's not going to work this time, and then it runs like 300 points, then you either wait to the third or the fourth day to buy the pullback. Okay, so that's another methodology you can use. Here's another example, YM daily. I've just highlighted some of the squeezes. All right. Nothing special. You guys know how to use it now. Here again, what do we have going on here? Reversal, total momentum reversal. This one here, you fired off this one's actually just a slight red, but this pattern here is what you're looking for on a momentum reversal. What else is telling you that it's going to go in the opposite direction? The TTM. Nothing special about the TTM. It's just taking the average of the previous 5 bars. None of this is really hard. It's real basic, and people that know anything about programming or indicators, this is real simple stuff. I hate taking just one indicator like the stochastic or just like the RSI, because in and of themselves they're kind of worthless. But if you compare 2 or 3 things together, they're a little bit more consistent. Okay? So you had a long here, then you had the momentum, you had the TTMs fire over. Momentum stopped right here, and then you went from blue to red. And then boom, you had a squeeze here, blue, you had a long here, momentum ran out here, and then you changed from blue, back to red, okay? That's on the daily again, okay? It catches good moves on different time frames. You just have to fit the time frame to your style, okay? If you're a swing trader, I don't recommend taking the 50-tick squeeze. Probably not going to be a good trade for you. Here's just some old examples. On a 5-minute chart. Probably my favorite setup, my two favorite time frames that I like this thing on, for scalping, I love the 50 tick. Write this down in your notes. On the 50 tick squeeze, the length of the line I changed to 15 instead of 20, okay? The average for most data vendors is 20 on Bollinger Bands, okay? It's usually 20 for Bollinger and 1.5 for Keltner, okay? But what I use on the 50 tick is I use a 15 length of the line, okay? For the Bollinger, yeah. And I don't mess with the Keltner, all right? So now on the 5 minute, I just leave it alone. It's just set to the default 20, okay? So here we can see we've got red dots. We have a blue dot. Well, this is just before I change the color. And when the indicator comes to you, I'll show you what it looks like defaultly, and I'll teach you guys how to change the color to whatever looks good to your eye, okay? Some people like red and green. Some people like the red and the chartreuse color. So it's the same thing. You just got to know how to work it. So here we had a long signal on the 5 minute. So about, 10,200, and it runs out of gas around 10,240 or so, okay? And then it fires off a short here. Momentum runs out about right here. You catch this move from here to here, okay? Market trades sideways and then rolls back over, but you didn't catch any with it. But are you going to whine and complain? You caught the move from like here to like here. That's a good trade. You don't have to try to catch this down to here. In order to make a living in trading, it's all about consistency and repeatability, not catching bottoms and tops and stuff. So then you have another long signal here, and then it just goes. Here's an example of a 2 minute chart with the squeeze, okay? Another example of when momentum topped out. On this one, you have to see it. I changed it, had the programmer change it. This is the old style. It's the same concept. I just had him make it look a little prettier so people could actually do it without going, no, that one's just a little higher. So you caught on the 2 minute chart, there's the long signal, there's the exit of the momentum, okay? Here's another example on the daily. The last signal that worked the best was this one. And it caught a move from and it's just when it went back in the squeeze. So, it caught a good point run, okay?
In those squeeze, you don't have the green dot.
Yeah, what do you mean? Yeah, this is the old version. This is the red dots mean stop and the blue dots mean go. You can also see where the histogram is green instead of blue. It's it's a prettiness thing. Because a lot of people, like when I was describing it in the room, they'll be like, the red, what? And I was like, okay, everybody drives. Red dot stop, green light go. So, it's easy to change in the indicator. Just another example of when the momentum ran out. You had a signal fire here. The momentum warned you twice to get out. 2 minute on the CBOT. We already talked about the total momentum shift. I just like killing you with examples so that you actually know what you're doing. Here's a perfect example. No. Gray area example, total shift. It almost was a perfect momentum shift. Missed it by 1 bar, but it's still one thing. If you use pivots, or if you use fib clusters, or if you use something else, if you have a squeeze that's firing off and you have like 1,000 tick reading, yeah, I'd probably hold off on it. If you're at R3 and you get a long signal, probably not going to work out for you. If you're up 120 points on the Dow, and then the 2 minute or the 5 minute fires off a long, air's a little thin up 120 points on the Dow. Okay, so you got to use a little bit of common sense. If you're at like R3 or S3 and it fires off, you just have to say, yeah, what's the probability of it actually going a little higher here? Okay? So in these cases here, this is actually, I think it's either a pivot or a fib cluster. So it fired down into support and you had a reversal signal and stuff. And all the rest of them were just a little example. So here's how I trade it. I enter the market on the first dot, okay? I use a 10-point stop, amazingly enough, just like yesterday. I sell a half as soon as I'm up 10 points. I move my stop from -10 to break even -3, okay? Then if the trade continues in my favor, I will sell a quarter at +20 or plus another 10. I'll move my stop to entry +3, okay? Last quarter of the position, I can do whatever I want. It's my reward, and I try to catch as much as I can on that one. And if I don't get bored, it works out good. If I get a little bored or a little lazy, I'll jump out too early.
Yeah, but you say you enter on first green dot.
Right.
If you've got like a tick chart, you never know when the dot's going to finish.
In TradeStation, you have a thing that's called a tick timer.
Oh, use tick timer.
You can use a tick timer on TradeStation, or you can just sit there and do it. It'll change color for you.
Well, you wait until it's just about to close.
You can do that, or you can wait for it to actually close. Yeah. The good thing about the 50 tick chart, that thing will fire off quick. You got to pay attention. So you can either use the audio alert. I forget what version fires when it's coming out, but yeah, just pay attention like on a 50 tick chart. You can either try to jump the gun, or which sometimes doesn't work out too hot.
So, how do you manage to trade like on a 50 tick chart?
Yeah. That's a good question, John.
I was just asking him how he would manage a trade like on a 50 tick chart versus a 5-minute chart.
Yeah, same way.
What was that thing about the tick timer?
There's in TradeStation you can get a thing where it'll count down ticks. It'll, like if you're using like a 50 tick chart, it'll go 47, 32, 4, 2.
Then you know when the next bar is about to form and everything.
Yeah.
It's one of those things though. If you install it the first day, you're just like, wow. Right. Did you do any trades? No, but I saw it count down.
Using like a 50 tick, and sometimes I see 233 ticks and everything. And I'm primarily a 1 minute trader. And who knows what the hell?
Difference between Mercedes and BMW? Well, nothing. I mean, it's a preference.
Yeah, they're both English cars.
There you go. I mean, there's no difference at all. It's just what's your style.
One's German.
Right.
Yeah. There's no difference. It's like a 1 minute. It's all right to look at. I mean, just not my style. Like he likes a little bit long. He likes the 233 tick.
Yeah, that's what I know.
I like the 50 tick. On the YM, he likes either the 89 or the 144. I like the 50.
All the trading that you do, time frames have been taught to me to be very important. Christine tells you don't start moving at the time frame.
The time frame does not mean anything.
I trade off the price ladder half the time.
You may find that a squeeze works better on a 5-minute pattern than a 1 minute squeeze. Well, I'm just telling you that the time frames and the tick charts, it's just personal preference is all it is.
I might try that 50 tick because that's less than 1.
If you don't like it, don't blame me.
I had to change it back.
If the first one doesn't work.
Yeah, first one. All right, so here's
this is crap. Throw it out.
20 in a row that was long, and then you follow.
Okay.
Yeah, I was wondering forever, like, how you came up with these wacky tick numbers.
The 233 tick,
Yeah,
they're fib numbers, fib ratios.
really?
Yeah.
Not to me.
I mean, even my moving averages, I use fibs. 8, 21, 89. I mean,
821. I've been meaning to ask you that.
Yeah.
You keep going on your videos. 80 MA is.
That's on a daily chart.
Yeah, the 8 EMA.
I use that on a 1 minute chart. 9 actually.
Yeah, and I will talk about moving averages later.
All right, so I'm gonna walk through how I trade one. Okay, this is like just an old chart, an old setup. The chart's a little old. Like right now, since it's summertime, I'm using like 5-point targets, and then as soon as I'm out of 5, I'm moving to my stop. Instead of -10, I use entry -5. So I move as the beta increases or decreases in the market. I kind of move around a little bit. I mean, I don't keep everything. It's either 5 and 5 or 10 and 10. Okay, so but the summer's been, the summer's actually not been too bad. It's just when summer comes, I get in a little bit more of scalp mode. All right. So in this trade setup here, we're going along. You've got a squeeze that fires off. It fires off along here. I enter at the purple line right here at 102.45. I immediately place my stop at 102.38. Here's a big distinction. I don't put in hard stops. I put a line on TradeStation. I actually move these lines around. As soon as I get close to the line, I execute my trades. Okay? Because I'm scalping. I can't afford to put it in an order and then go, oh yeah, and then pull it and then turn around and go, son of a... Forgot to cancel the other one. If I'm in a trade scalping, I'm in my seat, focused, in my bubble, trading my trade.
Well, and the thing about Hubert, he doesn't think about it. I mean, he'll sit there and you watch him trade and stuff like that. And it's like as soon as the stop hits, it's like your finger is automatically connected to. It's like think out.
If you have no discipline,
At market?
use Ninja, or Bracket Trader, or Strategy Runner, or Trade Maven. But I mean, if you're relatively consistent and disciplined, and you can sit there and go, "Oh, stop, ding."
You move those stops in an instant.
Yeah, but I mean, you just do it mechanically. You don't go, "Oh, it only went through like 8 points. What should I do?" You know, it's gone. All right. So in this trade, it works in my favor. So I'm selling half at plus 10. As soon as I do that, I take my red line and move it to where it's a break even minus 3.
But if
actually, my entry was right here on this black line. I'm sorry.
If you would have held on to all of it, you'd have made more money.
Yeah. That's probably true.
What if it went the other way?
Yeah. So my entry was the black line, not the purple line. This is break even minus 3 and break even plus 3. As soon as it goes in my favor 10 points, I cut half loose, and then I move my stop from minus 10 to break even minus 3, which is right here, okay? Trade continues in my favor in this example, up, so I sell a quarter here, and then I move my stop from here to here, okay? Now, the last point here, I either exit anywhere I want. I can flip a coin, I can get mad and just get impatient, I can do a tick extreme fade, a pivot number, just whatever. The last quarter is up to me. I can read time and sales. It's my shot to say, okay, let's see if you actually have any skills left. Okay? It's pretty easy. Here's another example. Here's another short. I manage the exact same way. You have a squeeze that fires off. I get short, 10-point stop. Trade goes in my favor. I cut loose half. Move stop to break even minus 3. Cut loose a quarter. Break even plus 3. And then the last quarter I get right here. Obviously, if I would have held it, I would have made more money. But on this example, the momentum ran out, and I was like, move's probably over. Okay? Some guidelines for the squeeze. All right. I don't hardly ever trade. I will micro scalp some during the doldrums, but not much. During the doldrums is a worthless time to trade. You will, however, get some massive moves from 11:30 to 2. Okay? It does happen. But as a whole, if you sit there from 11:30 to 2:30 and trade, you're going to wear yourself out, you're going to churn yourself, and you're going to take your account from this to this. Okay? It's, you're going to buy your broker a new house, but you're not going to be able to have one to live in. All right? I have a 3-strike rule. If I have 3 consecutive trades in a row that go against me, I stop for the day. And it happened last Thursday. Okay? Last Thursday I had 3 consecutive. I had whiff, and then I had a scratch trade, which was nothing, and then I had another strike. So after that happened, I was like, okay, gang, I'm done. If you want me to help you with market direction or call out some trades that I'm not going to take, I will, but I probably wouldn't follow them today.
Do you ever scale back into your trades?
No.
So you wouldn't count that if you did. Would that be considered a new trade? Or
once I'm in, I'm committed to my trade. And then I will scale out. And then after I'm out, I look for another setup.
Okay.
Now, here's one thing, a question like, all right, say I'm in a trade and I'm using a 10-point stop and I'm going in on a squeeze, and then it goes back into the squeeze like 2 minutes later and I'm still in a trade and fires off in the opposite direction. I don't just jump out. I either get my target or my stop gets taken out, okay? I don't go, I'm in this trade and I'm only out of half. Either my stop will get hit or I'll scale out on that last quarter.
So you don't observe the second squeeze firing on you?
When I'm in a trade, I'm in my bubble, I'm focused. Once I've got my signals and I'm committed to my trade, that's the trade. Okay? I'm either right or wrong. Okay? So if 1,000 tick fires off and it goes, you just went long, and now the 1,000 tick fired off. If it's going against me, and if I just read it wrong, I just read it wrong. That's the reason I have the 3-strike rule. So if I'm off, or my stuff, my market internals and directions, or my trading skill is off, it's just off.
Even if that new fire is in the same time frame?
To tell you the truth, I won't even see it.
Okay.
Because I'll be sitting here staring, waiting just to execute my trade.
Gotcha.
All right? 2 minutes. When a squeeze fires, I already talked about don't use R1. Be careful if you're getting a squeeze firing off at support or resistance. Just be a little cautious. Don't be too crazy about that stuff. you can read the rest of 285. It's just some general guidelines about being smart about when to take them and when not to take them. Time frames that I like, I use the 1 minute, the 2 minute. Probably the best overall signal is the 5 minute. It's really good for scalpers and for direction traders. And then I like the 89 tick chart and the 50 tick chart. And we already talked about how I do the 50 tick chart. I use the length of 15 instead of 20. All right, we're going to take a 5-10 minute break, and then we'll come back.